Understanding your 401k emergency options, a comprehensive guide when financial emergencies strike. Many Americans find themselves contemplating a difficult decision, whether to tap into their retirement savings. While financial advisors universally recommend preserving your 401k funds for retirement, life sometimes presents situations where accessing these funds might seem like the only option. This comprehensive guide explores the various ways to access your 401k funds before retirement, the implications of doing so, and alternative approaches to consider before making this significant financial decision. The fundamental purpose of your 401k. Before delving into withdrawal options, it's essential to understand why preserving your retirement savings is crucial. Your 401k account serves as a tax-advantaged investment vehicle designed to support your financial security in retirement. The power of this account lies in its ability to generate tax-free growth and compound returns over extended periods. When you withdraw funds early, you're not just removing the current dollar amount, you're potentially sacrificing decades of compound growth that could significantly impact your retirement security. Emergency withdrawals. Under new legislation, recent changes in retirement legislation have introduced more flexible options for emergency access to retirement funds. As of 2024, qualifying 401k plans now permit account holders to withdraw up to $1,000 annually for emergency expenses. This provision, established under the Secure 2.0 Act, specifically addresses unforeseeable or immediate financial needs relating to personal or family emergency expenses. While this option doesn't incur the typical 10% early withdrawal penalty, it does require repayment within 3 years and is subject to regular income taxation. Importantly, account holders must complete the repayment before becoming eligible for additional emergency withdrawals. Understanding hardship withdrawals. Beyond the new $1,000 emergency provision, traditional hardship withdrawals represent a more substantial option for accessing 401k funds. These withdrawals are designed to address what the Internal Revenue Service terms immediate and heavy financial needs. The scope of qualifying expenses is broader than many realize, encompassing various life circumstances that create significant financial strain. Qualifying expenses for hardship withdrawals include substantial medical expenses for yourself or immediate family members, costs associated with purchasing a primary residence, excluding mortgage payments, payments necessary to prevent eviction or foreclosure, certain home repair expenses following damage to a primary residence, educational expenses including tuition and room and board for the next year of college, and funeral expenses for family members. The process of obtaining a hardship withdrawal requires demonstrating that alternative financial resources have been exhausted. This means showing that regular income, insurance coverage, or the sale of other assets wouldn't adequately address the financial need. Plan administrators typically require documentation to verify both the nature and amount of the financial need. The true cost of early withdrawals. The financial implications of taking early withdrawals from your 401k extend far beyond immediate tax consequences and penalties. While the 10% early withdrawal penalty, applicable to those under 59.5, represents a significant immediate cost, the long-term impact on retirement savings can be far more substantial. Consider a hypothetical example. A $10,000 withdrawal at age 35 could reduce retirement savings by $100,000 or more by age 65, assuming historical market returns. This dramatic difference results from losing decades of potential compound growth. Additionally, withdrawn funds are subject to ordinary income tax rates, which could push you into a higher tax bracket for that year. Exploring 401k loans as an alternative for those seeking a less permanent way to access retirement funds. 401k loans present an alternative worth considering. These loans allow participants to borrow up to 50% of their vested account balance or $50,000, whichever is less. A special provision exists for accounts with less than $20,000, potentially allowing borrowing up to $10,000 even if it exceeds the 50% threshold, though not all plans include this exception. 401k loans operate differently from traditional loans in several ways. The interest you pay goes back into your own account, essentially meaning you're paying yourself rather than a financial institution. Most plans require loan repayment within 5 years through regular payroll deductions, though longer terms may be available for loans used to purchase a primary residence. However, 401k loans carry their own risks. Perhaps the most significant is the requirement to repay the entire loan balance if you leave your job. Failure to do so results in the outstanding balance being treated as a taxable distribution, potentially subject to both income tax and early withdrawal penalties. Strategic alternatives to consider before tapping retirement savings. Several alternative financial resources deserve careful consideration. An emergency fund represents the first line of defense against financial hardship. Financial experts recommend maintaining 3 to 6 months of essential living expenses in readily accessible accounts. The recent Secure 2.0 legislation has enhanced this concept by allowing employees to make Roth contributions up to $2,500 to employer-sponsored emergency savings accounts, though availability varies by employer. For health-related emergencies, health savings accounts, HSAs, offer particularly attractive benefits. These accounts provide triple tax advantages: tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. Maintaining 2 to 3 years of routine medical expenses in an HSA can provide crucial financial flexibility during health emergencies. Regular brokerage accounts offer another alternative worth considering. While these accounts don't provide the same tax advantages as retirement accounts, they offer greater flexibility in terms of contributions and withdrawals. Long-term capital gains tax rates often prove more favorable than the tax implications of early retirement account withdrawals, and investment losses may provide tax deduction opportunities. Roth IRAs present a unique option in emergency situations. While early withdrawals should generally be avoided, Roth IRA contributions, but not earnings, can be withdrawn at any time without penalties or additional taxes. This feature provides a potential emergency funding source, though it should still be considered a last resort given the impact on long-term retirement savings. Making an informed decision: the decision to access retirement funds early should never be made lightly. Consulting with financial advisors and tax professionals can provide crucial insights into the long-term implications of various options. These professionals can help evaluate alternative funding sources and develop strategies to minimize the impact on your retirement security. Remember that financial emergencies, while stressful, are often temporary. The choices made during these challenging times can have lasting effects on your financial future. Taking time to understand all available options and their implications helps ensure that short-term financial needs don't unnecessarily compromise long-term financial security. When faced with financial hardship, consider creating a comprehensive financial plan that addresses both immediate needs and long-term goals. This might include budgeting adjustments, debt consolidation, or exploring additional income sources before tapping retirement savings. The key is to approach the situation strategically, understanding that decisions made today will significantly impact your financial well-being in retirement years.